Stop. The number is $500,000. Not $1 million. Not $2. $500,000. Most people blow past this threshold without noticing. And then spend the next decade doing the exact same things that worked at $50,000. Applying them to a portfolio that is now large enough for those same habits to quietly cost them a fortune. The math does not warn you. It just changes. This is not a video about discipline, or long-term thinking, or staying the course. You know all of that already. This is a video about 3 specific habits that intelligent, disciplined investors, people who already did the hard part, need to stop doing once you cross $500,000. Not slow down. Not reconsider. Stop. Because the physics of your money has changed. And the habits that built the ship are now keeping it from sailing. Stick with me for 10 minutes. This could save you $1 million. Here is what happens. A person builds a portfolio to $350,000 through boring, disciplined, automatic index investing. Then somewhere around $350,000. Something shifts in his psychology. He starts feeling like he earned the right to be more sophisticated. He opens a separate brokerage account for satellite picks. A little sector rotation here. An earnings play there. An actively managed fund that a podcast guest ran. He spends 6 to 8 hours a month on this. He feels productive. He feels like he is doing the work. Here is what is actually happening. Over the past 15 years, 89.5% of actively managed US large cap funds underperformed the S&P 500. That is not one bad decade. That is the overwhelming, systematic, durable result. Professional fund managers with Bloomberg terminals, research teams, quantitative models, trying to beat the index, and failing most of the time. You think the problem is stock picking. Actually, the problem is behavior. A Morningstar study found the average investor trailed the funds they invested in by about 2.5% per year. Due to bad timing. Not because they picked bad funds. The funds performed fine. The investor bought late after a run-up. Got spooked after a pullback. Moved to cash. Came back after the recovery. 2.5% per year. On a $500,000 portfolio. That is $12,500 per year. Every year. Not from volatility. From watching too closely and touching the wheel too often. Over 20 years of compounding at 7%. That behavioral drag costs between $300,000 and $400,000. In foregone growth. A speedboat brain. Still trying to dart and pivot. Inside a cargo ship body. Here is the mainstream financial betrayal. Not a conspiracy. Not fraud. A fee structure designed to be expressed in percentages. Because percentages feel small. 1% does not sound like much. It sounds like less than your morning coffee. Here is what it actually sounds like. A 1% fee on a $1 million portfolio. Growing at 7% per year for 30 years. Eats roughly $1.9 million. From $1 million. $1.9 million from a fee described as 1%. Here is the structural injustice of percentage fees at portfolio scale. When your investments grow, the fee grows too. Even if the work your advisor does stays exactly the same. The work for a $3 million portfolio is not 12 times harder than for a $250,000 portfolio. But the fee is 12 times higher. Imagine a $500,000 portfolio growing at 7% per year. with no fees. About $2.71 million over 25 years. With a 1% fee. About $2.15 million. The difference? $560,000. $560,000. Not from a crash. Not from a recession. From a fee structure. That seemed perfectly reasonable when the portfolio was small. And scaled without mercy when it grew. Here is the reversal you need to sit with. You think your primary financial risk is market exposure. Crashes. Recessions. Corrections. But market risk is something you can ride out. Every crash in American market history has eventually recovered. Fee drag is something that never stops. Market risk works against you in bad years. Fee drag works against you every year. In bull markets and bear markets. Compounding opposite your wealth. Quietly. Reliably. Permanently. Every financial advisor ever told you to diversify. I know. There is a version they do not warn you about. It is called die-orsification. A term Peter Lynch coined decades ago. It happens when intelligent, anxious investors with significant money start adding investments. Not to improve returns or reduce real risk, but to soothe the psychological discomfort of having a lot to lose. Here is what it looks like. You have a clean, functional 3-fund portfolio. Total Market Index. International Index. Bond Index. Then you read about factor investing. You add a small cap value ETF. Then international stocks look undervalued. You add a separate developed markets fund. Then a friend in real estate tells you about rights. You add a real estate ETF. Then you hear an interview about inflation. You add a commodities ETF. And gold. Then you want dividend income. Add a dividend ETF. Then you realize you have 2 S&P 500 ETFs from 2 providers. Because you opened a second brokerage account at some point. You now have 17 positions. Congratulations! You feel diversified. Here is what you actually have. Research shows that 60 to 70% overlap is common among funds in the same category. Those 5 different large cap funds you own? They probably share 60 to 70% of the same underlying stocks. You did not diversify. You bought Apple, Microsoft, and Nvidia 5 times. In 5 different packages. With 5 different fee structures. And convinced yourself it is strategy. In extreme cases, an over-diversified portfolio closely resembles the market, but with higher fees, leading to worse performance. Each additional fund carries management fees and tax consequences. Meet Sandra. 51 years old. Works in project management. Built her portfolio from $0 to $500,000. Between age 28 and 47. Not luck. Not inheritance. Grinding. Boring. Effective. Index funds. Automatic contributions. Minimal touching. At 47, Sandra said, "Finally. Time to optimize." She did 3 things. She moved 20% of her portfolio into actively managed funds. Because she wanted more upside. She hired a 1% ORM advisor. Because now she had enough to feel like she deserved professional management. And she added 11 new positions to her portfolio. To make sure she was fully covered across sectors and geographies. None of those decisions felt wrong. Each was defensible. Together, they shifted her from a cargo ship captain to someone running a speedboat engine inside a cargo ship hull. Behavioral drag, active trading. 2.5% per year. On $500,000 over 20 years. The difference between 1.9 million and 2.7 million. A gap of roughly $800,000. Fee drag, 1% ORM. Over 25 years. No fee portfolio. $2.71 million. With 1% fee. $2.15 million. Difference. $560,000. Tax drag. Her portfolio returned 10% last year. But after taxes on dividends and capital gains, she kept only 7%. A 3% tax drag per year. A 500,000 portfolio can lose 150,000 over 20 years. In unnecessary taxes alone. Add these three drags together. Sandra, who did everything right to build to $500,000, is looking at a scenario where her optimization phase costs her well over $1 million. Not from any single catastrophic event. From compound friction that she never felt on any single day, because it did not arrive all at once. Step 1. The stop doing audit. Open your accounts. Convert every fee into a dollar figure. Advisor fee. Fund expense ratios. Trading commissions. Write it all down as an annual dollar total. Then ask yourself one honest question. Would I write a check for this amount today? People who do this audit almost always make at least one significant cost change within 90 days. Step 2. The overlap test. Take your full holdings list. Look up the top 10 holdings for every fund or ETF you own. Make a simple tally. If Apple, Microsoft, Amazon, or Nvidia appear in more than 3 of your funds, you do not have diversification. You have the same stock, bought 3 times in more expensive packaging. Step 3. Practice in action. For every investment move you are considering, a rebalance, a new position, a fund switch, ask yourself before you act, what is the cost of doing nothing right now? Below 500,000. Inaction Hazel cost, missed compounding. Above 500,000. The cost of action is frequently higher than the cost of inaction. Restraint is a skill. It needs to be practiced. The number is $500,000. You have either hit it, or you are heading toward it. Either way. Now you know what changes when you get there. You are not on a speedboat anymore. You are on a cargo ship. Speedboats win by maneuvering. Cargo ships win by reducing friction. Steady course. Hands off the wheel. The fix is almost nothing. You stop doing 3 things. You pick a simpler structure. You let the engine run. The cargo ship loaded correctly. Moving steadily with minimal drag. And a clear heading. Wins by enormous margins. Over any speedboat that keeps trying to outmaneuver the route. Here is what you will do right now. 1. Hit subscribe. Because the algorithm will not show you the next video if you do not. 2. Write in the comments one number. Your total fee percentage. Do not know? Find it tonight. This is the most important audit of your life. 3. Send this video to one person who says, now that I have money, it is time to get sophisticated. Tell them. Complexity is the cost, not the benefit. Because lazy investing built more fortune than complicated strategies. And the people selling you complexity have a financial incentive to make you believe the opposite. See you at the finish line. From the cargo ship.